Business owners, you need to watch this.
There are two main types of life protection that's available for limited company directors. The first one is relevant life and the second is key person insurance. In this video, we're going to look at the benefits of both, the tax benefits and how it can save you money.
So what is a relevant life policy? A relevant life policy is a cost-effective way for an employer to provide life cover to their employee. So essentially, the business will own the insurance policy with the beneficiary being the employee. So upon death of your employee, the benefit can be passed across to their family or the beneficiary. Providing life cover to an employee as part of the overall benefits package can help, number one, recruit more employees, but also retain that employee for a very, very long time. Are relevant life plans cost effective?
Relevant life plans can certainly reduce your tax liability. It's a great way for smaller companies to compete with your large rivals when you come to looking to attract employees. The cost to the employer can work out substantially less than if you did it in your own personal name. And that's because the tax benefits that you gain from that type of policy. This type of plan is usually allowed as a business expense by the HMRC. This means that all premiums paid qualified for full income tax relief and national insurance contributions, and also corporation tax relief.
So for a high rate taxpayer, this could mean a reduction in premiums up to 49%. For a basic rate taxpayer, this could mean a reduction in premiums of up to 40%. All relevant life policies are written into trust. Now, the main advantage of having a policy written into trust is purely for the fact that it stays out of the estate. So it's very, very good for inheritance tax planning.
Who are they suitable for? Well, relevant life plans are ideal for high earners with big pension funds who don't want their death in service to form part of their lifetime allowance.
Could also mean small businesses that don't have enough employees for a group life scheme. If you're a director taking a salary from the business, you can qualify for a relevant life policy, as well as any employees you may have in the business. A relevant life policy may be for them.
Most relevant life plans are taken on a level term basis, which essentially means the cover stays exactly the same. This can typically be a multiple of your salary. So let's say, for example, 4 times your salary or 6 times your salary. It can also be done as a fixed amount, so not linked to your salary at all. The next type of protection that's available for self-employed individuals is key person insurance. Put simply, key person insurance is there to protect the key people within the business. That could be the director of the business. It could be the sales manager within a business. It could be that you've only got one engineer within the business and you want to protect those. So essentially, the key person protection will pay out if that person was to pass away. It will also help with potential recruitment costs, loss of revenue occurred since that individual has passed away. When a business takes out key protection insurance to cover an employee, the premiums are typically a business tax deductible expense against corporation tax relief. This is because the payout is not for the employee, but it's for the business, and therefore is eligible for the relief.
So how can this help protect your business? The proceeds of a key person life cover can be used for recruitment of that key individual to do that role again, but also be used for the running of the business.
So what about cover for your partner or for shareholders? Well, losing a partner or a shareholder within a business can have a big impact on the success overall of that business. But it's not just the loss of profit that has a big impact. How do you retain control and assign fair value? So for example, you could be forced to work with somebody new, like a family member, that has no interest in the business or also has no knowledge of the business either. But because they now own a share, they have as much of a say within the business as the previous shareholders. What shareholder protection does is it provides peace of mind to the current shareholders that if anything was to happen to any of those, that they are all adequately protected.
It's vitally important that any credit borrowing that the business holds is also protected. Now, this is normally referred to as loan protection. So if you've got commercial loans, if you've got commercial assets which have loans on them, it's very, very wise to make sure that you have some life cover on them. That's to ensure that if a corporate partner or shareholder was to pass away, not only are you coping with the running of the business, you've also got to make sure that you are paying these debts going forward.
So just as a recap, there's 2 main key areas that you can look at protection if you are self-employed. The first one being relevant life plan and the second one being key protection insurance. Both types of protection have significant tax benefits and therefore can reduce your corporation tax bill if you have these types of policies in place. You can save up to 49% in premiums based on a personal life protection policy. So it makes sense to, when you own your own business, to potentially look at these options that are available to you.
If you're a limited company director looking at getting a mortgage, please check out our other video.